Hello, everyone. Josh Proctor here. I run CIBC Bank's Indianapolis office and am co-chair with Andrew Hedegaard of the Programming Committee for ACG. I want to welcome you today to our webinar. The coronavirus pandemic has abruptly halted the longest period of economic expansion in U.S. history, leaving businesses and investors looking for answers. To help weather that storm, the federal government has issued a number of economic relief and stimulus measures, including the $2.2 trillion CARES Act. Due to affiliation rules and issues with investor-backed companies being able to qualify for this, this has led to some major issues in the deal community. As shutdowns are extended, unemployment continues to soar, and new lending programs emerge. Where does this leave the deal community? Today, we're taking a closer look at the M&A outlook for the near-term future here, what deal makers and investor-backed businesses can do now and what they're saying. During the webinar, if you have any questions, please submit them using the Q&A button. And with that, I'd like to turn it over to Brian Schmidt at KSM, who will be moderating the webinar and panel today. Brian?
Yeah, thank you, Josh, and good morning, everyone. So welcome to the ACG Indiana COVID-19 webinar. Today, we're joined by a panel of experts who have been in the details of the COVID-19 economic relief and stimulus legislation for the past few weeks. Our panelists include Bob Greising, partner at Krieg DeVault, Kevin Depew, deputy chief economist at RSM, and my colleague, Ryan Miller, tax partner at Katzapper and Miller. So let's start with Bob. As soon as state governments started issuing stay-at-home orders and businesses closed or shuttered, the concern top of mind for every business owner was really cash flow. Obviously, this is significant for both operating companies as well as PEGs looking to acquire. Bob, would you tell us a little bit about the loan programs, where things stand as of today? I know they've been changing literally day by day, if not hour by hour, and then the impact of those programs on transactions. Oh, Bob, you're still on mute. Bob, you're on mute.
Yeah, sorry. I was navigating my screens. So, anyway, thank you, Brian, and good morning, everyone. Glad to help out. As was mentioned, I'm with Krieg DeVault. We do a lot of transactional work. We've been a sponsor of ACG for a long time, and certainly part of my attention over the past month or so has been on what's going on with COVID. And my focus has been on the impact on businesses, deal community, small businesses, and so on. So, and Brian, you're right. The big focus has been on making sure that that people still have dollars in their pocket, and that's one of the primary focuses of the CARES Act and one of the programs that has gotten a lot of attention, called the Payroll Protection Program. A couple of others that are in play that I really won't spend much time on today, but there's also the Economic Injury Disaster Loan that has $10 billion available to it, and then a program that's still sort of in formation. It has been announced and some of the parameters are known, but not much guidance there, which is the Main Street Loan Program. But focusing on the Payroll Protection Program for at least a few minutes here, I'm going to run through just some of the highlights that probably everybody knows and then try to get to the impact on the deal community. But it's really intended to help small businesses, which has been one of the issues of availability. Am I a small business or not? And so the general listing there for eligible borrowers are businesses with under 500 employees. Some industries allow a higher headcount, and that is also accommodated. But for most of us, it'll be the 500 employee level. And I'll get into a little bit, but that's been the hitch really for the private equity deal community. Great benefits are that it's a low rate loan, and you can have that entire loan plus interest forgiven. The total availability is $349 billion, which sounds like a lot. but it has gone fast. Congress has a lot of pressure on it to expand that. And if you've been following that, they may be meeting even this morning on that. And then the program expires, if there's any dollars left, on June 30. Next slide, please. So you can only get one loan per employer. So they've tried to find ways to avoid gaming the system. There is a big push to apply now because it is first come, first served. And as of earlier this week, $250 billion had already been committed. And I saw a number yesterday that number is pushing up closer to 300 billion. And so you can see that it is most likely on the trending lines, predicted to be fully committed at the end of this week. There had been some thought it would last at least until June. But because of all this and the value of it, and clearly the volume of interest and the widespread across all sectors, Congress really is under pressure to increase that. I mean, you really want to make it available to the people who are going to vote for you. And so there's been a lot of pressure. And the typical trade-off of the standoff in Congress is how do we do that? Some quick items on the availability. You can get up to $10 million, but the lower cap is 2.5 times your average payroll for the past 12 months. And then you can also, if you have participated in the EIDL, you can include that as part of your financing. 1% per annum, 2 years, and I mentioned for the amounts not forgiven, if you have total forgiveness, there is no payment, but there are some uses that are not subject to forgiveness, or you also need to use the funds in the first 8 weeks after you get the money. So if you have not fully deployed it in that 8 weeks, you would still have the balance that would be subject to repayment. And payments are deferred for 6 months. And a key for this program, most SBA programs require that it be secured and that there be a personal guarantee, and that it's almost like a lender of last resort. You had to have looked for money elsewhere to get credit elsewhere. And this program waives that requirement as well. And so the issues for the deal community are really, how do I make sure that my portfolio company or my target company or whatever is eligible for this? Because it's, as I said, it's sort of free money. You receive the money, you use it for proper purposes, which are payroll, rent, utilities, and interest on mortgages. You can use it for a few more things, some like interest on pre-existing debt and a couple of other uses. But the amount that'll be forgiven is limited to those first 4 categories. And so you can get, we've heard reports of people that have already gotten, close to the cap, close to the $10 million. So that would be very helpful liquidity. But if you have more than 500 employees, you are not eligible. And this is where the affiliation concept comes in that a number of people have talked about. We have a wide-ranging, expansive concept. We're all familiar with the typical affiliation of controlled entities or common control. Here it expands to management concepts. And so if you have some common management, you are subject to this. You also have the risk that if you are under an agreement, some sort of a shared agreement, management agreement, or if you're under an agreement for a merger, an agreement in principle will also bring in that party, with the concept being that that's really now the beneficiary of this program. And there's also a focus on negative control. So if you can control the board through various negative things, basically veto powers, like the board cannot decide X without my approval, even though I'm a 25%, 30% shareholder or owner. Then you have also the possibility of being considered insufficient affiliation to be aggregated. And for private equity companies, if they're using a platform company and you have a bunch of subs and you're all under some common investment portfolio, either through direct control through a majority position, or if you have a minority but still can sufficiently control the board through these negatives, then you're going to be considered an affiliate. The deal community or the private equity community has not been successful in getting Congress to change that. So a couple of workarounds that have been identified in the guidance that's out there is that if you irrevocably give up these hooks to controls, such as these negative controls that I mentioned, then you can break that affiliation connection. Apart from that, we've not seen really any opportunity to get around it other than to present some of these other softer positions like managerial oversight as not really being an effective control. The other thing that has happened actually just a couple days ago was some clarity on what is considered payroll costs. With S Corps, with LLCs, a lot of owners don't get W-2 income, but they get K-1 income or self-employment income. And guidance came out that confirmed that now can be considered a payroll cost. So that's a positive development for entering into ownership relationships in the deal community. And then, yeah, thank you. Then in terms of what is happening, we've been fortunate to be involved with quite a few transactions this spring. Things were going really well. And some of the things that we've experienced, and also I think I'm seeing with other people that I'm talking with, is if you've got a deal on the table, or if you even have one that is under agreement, several things are happening. Delays, people just say, hey, I'm going to rethink this, let's wait and see what happens. And as a good friend of this community, Chris Knipp told me one time, time kills all deals, or is the enemy of all deals. I forget the exact quote. So if you're going to delay something, you are, I think, unlikely, or at least you run the risk of never really relaunching. We also have seen people triage and prioritize. It's not that they're not doing deals, but they're not doing as many of them. And so they may have 5 deals on the table and decide to really focus on 2 or 3 of those. And so if you are one of the targets that gets triaged to the cutting room floor, as they say, then you will lose your opportunity. But if you are one that is a strong target for the acquirer, then you may survive and will continue on. And then we also are seeing people just continue to pursue it. Some of it under repricing. Hey, it's just too expensive with too much uncertainty. We need to take that into account. Some are trying to identify risk-sharing opportunities, maybe a bit more seller financing, maybe an earnout, higher escrow amounts, more specific targets to the corona risks that have been identified. But they're still getting pursued, and you're just going through another round of negotiations for that. Then the next slide, please. The big focus here would be on the what is considered a material adverse effect or material adverse change. We're all probably pretty familiar with that in general concepts, but we really need to drill down on whether the COVID-19 situation constitutes a MAC or a material adverse effect. You need to look very carefully at the specific language. Sometimes it is and sometimes it isn't. The more current practice in language that has developed over the past couple of years is that this pandemic arguably is not a material adverse event if you assume that the impact on the target is not disproportionate. You generally say anything that happens that's adverse to the business is a material adverse event. And then you carve out those things which are sort of general things that happen in the economy. You know, the election goes wrong, or there is some other catastrophic event that affects everyone. And that is generally well accepted. And then more recently, you then do another one saying that if this general event does have a disproportionate impact, then that can be considered a MAC. And that's where here, COVID-19 for some industries would be very positive. If you had hand sanitizer business, you're probably doing great and you don't have a material adverse effect. You know, for most everybody else, there is a general malaise, but a lot of that is not disproportionate. It's not like you are suffering more than others are. So there's an argument that it is not MAC. In the financing side of it, a lot of financing commitments are subject to also similar no adverse changes. And those tend to be a little bit different than you'll find in the deal documents. And so you want to do some further due diligence on what that looks like. And then in the signed deal area, a MAC clause or material adverse event clause oftentimes is a condition to closing. And so you need to be able to, if you're on the sell side, you need to be able to demonstrate that this has not been triggered because you are not experiencing a MAC or material adverse event for purposes of the agreement. Going forward, this is going to certainly change the due diligence that is there, looking into this a little bit more. What is the impact? What's the impact on the supply chain? What's the impact on your customer base? Are they an essential business that has been continuing to operate? How is the financial prospects going forward? So you're going to have a much deeper dive on those things that are now being demonstrated with the impact of a pandemic such as we're experiencing. And then a lot of ways that we've seen recently is the reps and warranties insurance and the impact that is there. RWI is intended to really protect against the unknown. And so once the pandemic is in play, you're going to, it's no longer unknown. So if you don't have a policy in place, then you're going to have likely face some exclusions or exceptions to the coverage. This is still playing out quite a bit from things that I've been reading, but it's not that you won't be able to obtain it, but that the exceptions and exclusions will be clearly directed towards the impact of a pandemic once it kicks off. And then the other question that we're dealing with here is, if I do get one of these loans and I'm in a deal, who gets the benefit of this? The loans themselves, if they're committed and you have a deal that's in between, that should be an asset of the company, and therefore it would go with the company. If you're in an asset deal, you want to make sure, and you're the purchaser, you want to make sure that that benefit goes to with the purchaser. It's unclear. There's no guidance directly about transitions like this, so this may encourage a stock deal if this was really a critical element of it. And the same thing applies to the forgiveness. If you have the loan in place and then you do a deal prior to forgiveness, who gets the benefit of that? I do think this is also a stock/asset conversation, and so you'll have to look at that carefully. But from what we can tell with the guidance that's out there right now, is that it would be considered an asset that is manageable by the seller and the purchaser as part of negotiations with that. And then with one last thing that we're seeing is the question of what happens if you sort of stop being eligible, that you combine and now you're over 500 when you weren't before. That again, there's no specific guidance on that. You know, as I've thought through this, I've concluded that if I were growing and hiring people and I went from 495 employee count and eligible, and I hired 20 people and so I'm over 500, do I lose? Do I have to pay the money back? There's no indication that that's true. So if you do that in the deal setting, I think you can make the same argument. However, there are some other policy concerns of whether or not the system is getting gamed and you set this up to really provide this benefit to a company that really should not benefit from it. So that guidance is still waiting to come forward. And then finally, a couple of things real quickly is the force majeure issues. We want to check out your contracts with that. Check out your business interruption insurance claims. You want to take a look at your financing documents to make sure that no defaults are occurring. And then for the decision makers, there is some indication that your fiduciary duties expand in an insolvency or financially stressed situation. That's not the case in Indiana, and when it's been considered in Delaware, it's very few circumstances. The one that might be more interesting is what's known as the Caremark cases, where you have an obligation to assure that you have systems in place to monitor identified risks. And so if you don't put things into place, the people to whom those duties are owed may come back and be unhappy with you. So that's a high-level summary, Brian, and I apologize for taking up more of my time than I expected. It went faster when I was speaking quickly in the shower this morning. So.
Well, thank you, Bob. That's great information, and I know we'll circle back as questions are coming in. So now let's turn to Ryan Miller. So Ryan, aside from the immediate cash flow needs, there are a number of tax provisions in the CARES Act and in the Families First Coronavirus Response Act that may provide additional ways to soften the economic blow of the coronavirus. Would you walk us through those tax opportunities and what they might mean in terms of cash refunds, credits, et cetera, for our attendees?
Yeah, absolutely. Thanks, Brian. So there are 3 new payroll tax provisions that require immediate attention from anyone looking to take advantage of them. And there are a handful of retroactive income tax changes that can provide a current cash refund opportunity. So first up are the payroll tax credits provided by the Families First Act. So as a general rule, Families First requires employers with fewer than 500 employees to provide emergency paid sick leave and emergency paid family leave to employees, and the amounts that are required to be paid are subject to various caps. Now, whether or not the act requires a particular employer to pay these benefits is a legal matter for the employment lawyers to determine, but as a tax guy, I'll say that if you are required to pay these benefits, you will be entitled to refundable payroll tax credits for the wages paid pursuant to the new requirement. Now, the goal of these paid leave credits is to provide employers with a full reimbursement of the cash needed to pay the new leave benefits. Thus, the credit amount starts with the required wages paid, and it is increased by an allocable share of qualified health plan expenses incurred by the employer, and it is increased by the employer portion of the Medicare taxes paid on such wages. Now, these are payroll tax credits. So the credits will be reported on the quarterly employment tax form, the Form 941 filings. However, employers can fund the payment of the required leave benefits in real time by retaining the anticipated credit amount from required payroll tax deposits. All right, so the next 2 slides cover 2 payroll tax provisions within the CARES Act. So that first slide was the Families First Act. Now we're starting the CARES Act. And the 2 payroll tax provisions within the CARES Act are coordinated with the Paycheck Protection Program, the PPP loans. And first here we have the employee retention credit. So qualification for this credit is determined on a quarter-by-quarter basis. So first, you must be an eligible employer for the quarter in order to claim this credit. And you're an eligible employer in one of 2 ways. Either your business operations were fully or partially suspended due to orders from an appropriate governmental authority related to COVID-19, or you experience a significant decline in gross receipts during the calendar quarter. Now that first test, the full or partial suspension of business operations, involves a little bit of uncertainty with how broadly it can be interpreted. But that second test is more of a bright line mechanical test whereby an employer experiences a significant decline in gross receipts if gross receipts have declined by more than 50% as compared to the same quarter in 2019. So those are the 2 tests for how you become an eligible employer. If you are an eligible employer, the credit is equal to 50% of qualified wages paid up to $10,000 per employee. So the credit is a maximum of $5,000 per employee. And this credit will have much broader utility to employers with fewer than 100 full-time employees in 2019. Now this test is determined based on the average number of full-time employees during 2019, and you must consider the applicable aggregation rules, taking into account businesses under common control and whatnot. But If you have fewer than 100 employees per this test, then all wages you pay during the qualifying period are qualified wages, whether the employees continue to work or not. If you have over 100 employees, then qualified wages include only wages paid to employees who are not performing services during the qualifying period. So in other words, if you have over 100 employees, this credit is only available to the extent you're paying employees that are not working. Claiming these credits are similar to the paid leave payroll tax credits. You can retain expected credits from payroll tax deposits, so you can get the cash kind of immediately and on a real-time basis, all getting reconciled on the Form 941 filings. And finally, important note that you cannot claim the employee retention credit if you received a PPP loan, okay? So next, the next payroll tax provision is in the CARES Act as well, and this is the ability to defer payment of the employer portion of the Social Security tax. So this is the 6.2% tax. You can defer payment of that tax for the rest of 2020. And all employers, regardless of size, are eligible to do this unless they have a debt forgiven pursuant to a PPP loan. So again, coordinated with the PPP loan. Now, I want to stress that this is just a deferral. Whatever amount you defer during 2020 does become due and payable in 2 equal installments on December 31st, 2021 and December 31st, 2022. Thus, if you take advantage of this provision, just be sure you keep track of the 2 balloon payments on what essentially amounts to an interest-free loan. So don't forget, you have to pay this back, but it can be a very valuable short-term cash flow tool. All right, so we're moving now to the CARES Act and the retroactive income tax changes that could allow for an immediate cash refund via amended return filings. So the first bullet point is the limitation on a taxpayer's ability to deduct business interest expense. So this can be important in highly leveraged deals that have significant interest expense and or deals that have first-year tax write-offs that suppress taxable income. The CARES Act came in and increased the allowed interest expense deduction from 30% of adjusted taxable income, or ATI, to 50% of ATI. So ATI is basically an EBITDA calculation through 2021, so earnings before interest, depreciation, and amortization. So the increase from 30% to 50% is true for taxable years beginning in 2019 and 2020, with one important exception. Partnerships are still subject to the 30% ATI limit for 2019. However, the partners of the partnership will receive some relief from this limitation on their 2020 tax returns. And the other change made to the interest expense limitation is the ability to determine your limitation on your 2020 tax return based on your 2019 ATI or your 2020 ATI. So on your 2020 tax return, you can choose whichever ATI calculation results in the largest allowable interest expense deduction. So the next bullet point is qualified improvement property, or QIP. And qualified improvement property are fixed asset additions to the interior portion of a non-residential real property building, but only when the QIP is placed in service after the date the building itself was first placed in service. The CARES Act changed the depreciable life for QIP from 39-year property to 15-year property. So this allows for more accelerated depreciation deductions, but more importantly, this change makes QIP eligible for bonus depreciation, which can be a full write-off of these fixed asset additions in the year the property was placed in service. So this change is retroactive back to QIP placed in service after December 31st, 2017. So the 2018 and 2019 tax returns are impacted for calendar year taxpayers. And so anyone that had QIP additions in 18 or 19, there may be refund opportunities available to those taxpayers. And you'll likely have 2 options for taking advantage of this change. You can amend the prior year tax returns, or you can file an accounting method change with the next tax return you file. And the path that you choose here will vary taxpayer to taxpayer based on a variety of circumstances. So a discussion with your primary tax advisor will be needed to make that decision. And the last point we're going to spend a minute or two on is the increased ability to utilize net operating losses. So the CARES Act provides that NOLs arising in taxable years that begin in 2018, 2019, or 2020 are now to be carried back 5 years. Thus, for example, if you had a 2018 net operating loss, you now need to carry that NOL back to 2013 and then forward until it is used. If you do not want to carry back the NOL, so you'd rather carry it forward, then you must make an election for each NOL year, and this election is made as an attachment to your 2020 tax return. So you have some time to make that election. Technically, it is supposed to be attached to the tax return for the first tax return you file for a year ending after March 27th, 2020. So again, if you're calendar year taxpayer, you're just going to attach these elections to your 2020 tax return when you go to file it. Now, taxpayers that are going to carry back the 2018 NOL and submit an immediate refund claim need to review their options sooner rather than later. The service has provided that so-called quick refund claims for a 2018 NOL carryback can be filed by June 30th, 2020. Now, if you miss this June 30th date, you can still carry back and claim a refund, but you might not be able to do it via the quick refund claim. So that's a decision point to be made by the end of June. And the other important change to the utilization of net operating losses is that the NOL deductions can fully offset taxable income until 2021. So before the CARES Act, the NOL deductions could only offset 80% of taxable income. So with respect to NOLs, you've got a carryback that you can look at, you've got a quick refund claim you can make if applicable, and you can also offset all of your taxable income instead of 80%. These last few bullet points real quick. The overall loss limitation is a limitation imposed on an individual income tax return. So this limitation was new for 2018, and now the CARES Act has retroactively repealed this limitation to 2021. So if you are an individual that was subject to a business loss limitation in 2018 or 2019, you will likely need to amend your tax returns as this limitation no longer applies. And if there are any C corporations out there with AMT credit carry forwards, the CARES Act provides that you can file for a quick refund claim of the remaining AMT credit rather than waiting until 2021 to fully utilize this credit. And here again, the 2018 quick refund claim for the AMT credit, here it is due by the end of 2021. So it's due by December 31st, 2021. And moving on, the last bullet point here, the only thing I'll note about the postponement of the deadline to file returns and pay the taxes is that any tax return and tax payment covered by the relief that was otherwise due on or after April 1st and before July 15th is now due July 15th. And this applies to due dates falling within this time period that are the original due dates, as well as due dates that are the extended due date for those returns. So that was a very quick overview of a few of the tax considerations that could have immediate impacts on cash and cash flow. So.
Great. Thank you, Ryan. Appreciate that information. I'm sure we'll be circling back as questions starting to come through. So now let's turn to Kevin. Another concern is whether or not we are going into a recession, are we going into a depression, how long that could last, and then what economic recovery might look like. Kevin, would you talk us through your economic outlook and your thoughts on how long it might take for the economy to recover?
Yeah, sure, Brian. So just at a high level, just to set the baseline of where we started, we've suffered a series of severe economic shocks. It's abnormal to have a supply shock, a demand shock, and a financial shock occurring all at the same time. These are near 7 standard deviation shocks that exceed what we saw during the 2007, 2008 Great Recession, financial crisis. And so while these are depression-like, you have to go back to data series in the 1930 to 1945 time period to find similar data that we're going to see over the course of the next 4 to 8 weeks. We're not in the camp that believes that this will morph into a full depression. Instead, we think it'll be a very severe recession that's likely to last about 2 to 3 quarters. And a lot of that mitigation has to do with what has been a fairly robust fiscal and monetary policy response. On the monetary policy side, the Fed appears to have learned some lessons that from the Great Recession and the response there, where a lot of it was very sluggish out of the gate. People were afraid to, on the Fed, they were afraid to go through all of the, or implement all of these unorthodox monetary policy tools that at the time were unorthodox and now become much more normal. So you saw the very fast response on the monetary policy side. The fiscal response has been fairly robust as well. And one thing that we say about this is to think of it in terms of a process rather than event. So what we mean by that is that all of the things, the policy responses that we've seen so far, robust as they may be, will require some additional responses as we get through this crisis, deeper into it, and get to the point where we begin to reopen the economy and really see what the behavioral changes are that are going to impact many of the portfolio companies that certainly private equity is dealing with. So what we're most excited about is the implementation of the Main Street lending program. That was something that at RSM, my colleague Joe Basuelis was in consultations with the Treasury and the Fed. That's the one that really moves the needle for the middle market companies that we're focused on. So in terms of what we look like as we move through this crisis, we think that you can probably take the V-shaped recovery off the table. Even when you look at data from places that have successfully reopened, China, for example, South Korea, there's not really a V-shaped recovery. Instead, we think that businesses need to anticipate a very elongated and in some cases frustrating recovery. So particularly in those frontline industries that have been the hardest hit so far. So your consumer-facing industries, travel, hospitality, restaurants, food and beverages, leisure. Those are ones where it's going to take some time for people to get a comfort level with going out and being in large groups. If you own restaurants here in New York City, for example, prior to the full shutdown, a lot of the restaurants faced 50% traffic curtailment. So that was a requirement mandated by the city. So I think that is something that has to be considered on the restaurant side. If you are only able to cater to 50% of your seating capacity, what does that economic recovery look like? How quickly can you get back to what is more of a normalized environment? Andrew, next slide, please. Okay, so this morning we did get the initial jobless claims. Our forecast when we started to see this a few weeks ago, 4 weeks ago, was that we felt like in the initial wave there were about 24 million jobs at risk. So here a month in, based on initial jobless claims this morning, there were 22 million jobs that have been lost over the past 4 weeks. The forecast for this week, the consensus forecast was about 5.5 million. It came in a little bit below that, so that's good. We've obviously seen the initial peak in initial jobless claims. Right now, we're at about almost 12% unemployment in the economy. And just as a baseline, you can think that you can figure that for every 1.5 million in initial jobless claims that are filed, that equals about 1% increase in the unemployment rate. Our view is that we'll probably peak somewhere in the 18 to 24% range a little bit later this year, and some of that depends on the social distancing measures, how soon they're relaxed. For other parts of the country that may not be as hard hit, and it's likely that the White House will release those new social distancing guidelines later on today. Next slide, please. So this is our RSM monthly GDP tracker. It's an index of economic activity, and you can see what the forecast is. This is very preliminary based on what Q1 should look like. I think that you can anticipate that this chart will look much different by the time we get to July or August. And we're almost certainly to exceed the depths of what had previously been the largest economic decline and largest GDP decline since the Great Depression. So we're certainly going to move past that. But we do have a sense from some of the incoming data, retail sales that came in yesterday, which were obviously terrible, even when you look under the headlines. The control group number, which was actually positive and the forecast had been negative, that's the one that goes into the GDP calculation. That was boosted by a lot of front loading of supermarket and grocery items. So that's unlikely to persist. I think that what you'll see is that will translate into some very woeful data as we go through the next 4 to 8 weeks. Next slide, please. So the big question is how long before the U.S. is back to full production? And obviously that depends on the success of some of the scientific and public mitigation efforts. Our forecast right now, and we don't know, nobody does, we're not epidemiologists and we're not even going to pretend to play one, but that based on what we know, that the economy should begin to recover sometime in the late June to early July period. But I think you can anticipate that there's going to be below output production for the remainder of this year and into 2021 until we get to either a vaccine or get some additional data or indication about whether this will become a series of virus waves, if it has seasonality, or if there is perhaps on the positive side more herd immunity than what we do think is, or what the testing shows is in the economy right now. Because of the number of asymptomatic cases and the people who are not being tested, we simply don't know. And the data, even when you're looking at the curves that are being presented for your state and for the nation as a whole, that's incomplete data set. It's like trying to understand the game of basketball and your only data set is the NBA. That will tell you about the NBA, but it doesn't tell you about what the game of basketball looks like from a data standpoint for everybody in the global population that plays it. So there are a number of factors that are going to make reopening the economy fully difficult. Will we see a consistent decrease in the number of cases? How soon in places that have been hard hit? New York, for example, New York City, obviously, if you're trying to reopen the full economy and you can't have business back to normal in New York City until September at the earliest, or possibly even late into Q4 or Q1, that's going to have a significant impact for the national economy. The testing is insufficient until you get to a place where you are able to test the entire population, able to discover whether it's an antibodies test for those people who had been infected and were never even aware of it. Until you can get that, then you're at best operating under conditions of extreme uncertainty, and there is uncertainty on both sides. And this is often the case in financial markets, which is kind of what this compares to in terms of opening the economy. There's really no wrong answer right now because the data is insufficient to be able to tell you what the right path is. We may be erring on the side of over caution, in which case that the second order effects of keeping the economy closed are going to be, as the president said, a cure that's worse than the disease itself. Or if we reopen the economy too soon, then we may find ourselves in a series of cascading shutdowns that continue to stress the medical community and the ability to treat those patients who do get the disease. And then you have a much longer path to reopening. And so it's really an uncomfortable position for policymakers to be in because there's no right answer to this. There are just a series of equally unknown outcomes. And some of those outcomes, no matter which way we go, could be bad. Next slide, please. So this is the curve. It has been updated for the most recent data. We're obviously at about 600,000 cases in the U.S. But the good news is that around April 4th, the curve did start to flatten. Our fitted curve projected that we would have had about 600,000 cases as recently as Easter Sunday. So here we are on Thursday past Easter, and the curve has bent. And we are starting to see at least some positive news there for many businesses and for many communities that have been hard hit. Next slide. So just to open up the Q&A, and I know, Brian, you probably have a series of questions and those that come in. The main thing that I would leave people with is that from what we understand, the Main Street lending facility will significantly move the needle for middle market businesses. The comment window closes today. So based on that comment window, there will likely be adjustments to what the Fed has released. And so some of the concerning areas there, certainly on the private equity side, is the leverage that's allowable through the Main Street lending program, 4 times EBITDA for the new lending facility based on 2019. I think there is some potential to see those allowable leverage ratios relaxed a bit, and that's one of the concerns. I know that a colleague of mine just went through a random stack of valuations on his desk and couldn't find any in that stack that met the threshold of 4 times. So I know that's a key question, and hopefully once we get through the comment window today, there'll be some more clarity around what that program is actually going to look like and what the adjustments will be made.
Yeah, thank you, Kevin. We certainly appreciate your thoughts, and we've gotten a number of questions that have come in. So let's maybe dive a little deeper into the specifics for all of our panelists and kind of tackle these questions. So not shocking that we've gotten a number of questions about the PPP loan. That's what I feel like I've spent the last 10 days of my life talking over and over again about. So I'll throw this out to any of the 3 of you to comment on, but maybe Bob, I would start with you because I think you mentioned this in your part of the presentation that the guidance just came out that you could include K1 amounts in the process. And we have a question regarding what happens if I've applied using payroll numbers and I did not include the K1 amounts. Do we have any guidance on that from the government at this point?
Yes, you can file an amendment to your application. You need to work with your lender. You don't want to do it as a new application. That was that 1 loan per employer limitation that I had. But we know a number of people that are filing amendments, and the lenders are receptive to that. So that's probably the quickest and easiest way to address that.
Great, thank you. Ryan, I think this one probably swings a little back to you, some things that we've talked about previously, but do we know if I hire new employees in the 8-week period where I'm counting my eligible costs for the PPP loan, will those wages for the new employees, can I defer those for Social Security tax purposes? You know, what's the interplay there between hiring new employees? Also, if I'm doing, as we've had a couple of other questions about if I've received PPP funds, but I'm doing the deferral, at what point does the deferral need to stop?
Yeah, so there's no differentiation, I don't think, between new employees you hire and existing employees you continue paying. And we weren't sure until last Friday what would happen if I started deferring my Social Security taxes and then I had a debt forgiveness under the PPP, because the debt forgiveness, you know, that won't come for 8, 10, 12 weeks from now. And we weren't sure what would happen, but we finally got some guidance and clarification from the service. And they said, if you have a PPP loan, you can go ahead and start deferring the Social Security taxes now, and you can defer it all the way up until the date you are notified by your lender that that a debt has been forgiven under the PPP loan, and that's the full debt or a partial forgiveness. So once you're notified by the lender that any portion of the debt has been forgiven, then you can no longer defer taxes after that point. You have to start paying the employer portion of the Social Security tax. But whatever you did defer up until that date continues to be deferred, and you pay it on the 2 equal installments at the end of 2021 and 2022.
Great, thank you. Bob, I'm going to throw this one back to you. We've gotten a couple of questions just really regarding the affiliation rule and what happens if I'm a U.S. company that I own a foreign entity, a foreign subsidiary, or vice versa. I have a U.S.-based company that has foreign ownership, and if I add in the employees of the foreign entity, it pushes the employee count over 500. Do those need to be included? Do we have clarity on that issue?
A couple things, Brian. One reminder is that the employees that receive the benefit of this need to be U.S. based. It's focusing on keeping money in the U.S. economy. But going to the question of the affiliation does not distinguish on a foreign versus domestic basis. It's trying to understand if the business is a small business where the policy objectives are intended to benefit that. So my initial reaction would be that the affiliation rules would apply, and you would need to aggregate all of the affiliates, both foreign and domestic, in determining your headcount for eligibility.
Great. So Kevin, I'm going to turn this one back to you. I know with so many of our private equity clients and contacts, there's just been real heartburn over the 500 employee kicking them out of the PPP loan. So they're all very interested in the Main Street lending program. Do you have a feeling for when the actual start date might be for that lending program?
Yeah, Brian, right now, our best consultations with Fed and Treasury suggest that it will likely be May 1st. I would say that is going to be the farthest date out. So I think that they'll want to underpromise and overdeliver on that. So it might be a little bit before, but I think that gives you some sense that this is a very on the surface, it seemed like it was very simple compared to some of the provisions in the PPP. But when you start to look at what the comments that, based on what we've heard from private equity are coming in, that it'll probably take them another 7 to 10 days to really get something up and running that's successful.
Great, great, thank you. Ryan, this one comes back to the payroll tax credits that you were covering earlier. Can you explain how they fund the payroll tax credits by reducing the payroll tax deposits?
Yeah, sure. So when you go to make your payroll tax deposit, and those deposits consist of federal income taxes you've withheld from employees, and it consists of both portions of the Social Security and Medicare taxes, the employer and employee portions. So when you go to make that deposit, for example, let's say you have earned or you expect to have a $5,000 payroll tax credit, either employee retention or paid leave credit, and you're getting ready to make an $8,000 payroll tax deposit to the government. Well, you can retain the $5,000 out of that deposit and only deposit $3,000 to the government, and then that all gets reconciled on the 941. Now, if you expect a $10,000 credit and your deposit is only $8,000, you can retain the entire $8,000, make no deposit to the government, and you can file a Form 7200 to claim an advanced credit of that additional $2,000. So that's a new form the service has provided for this purpose. So, so you really can receive the cash benefit from these payroll tax credits in real time. You don't have to make all your deposits and then claim a refund on your 941. You can retain these credits from those deposits, and then it just gets reconciled on the 941 filing via the credit claim. Great,
great. Thank you, Ryan. So Bob, back to some of the information that you covered for us in your very first section. We've got a question about a MAC, a material adverse change. The question is, what happens when a MAC is triggered?
It's very deal specific. You need to take a look at the underlying transaction. For an acquisition transaction, a MAC is almost always a condition to closing that no MAC will have occurred. And so if it occurs, then you have a potential of a failed closing condition. And one of the implications there is that if you had basically a termination fee of some kind, that you may not have triggered that termination fee because your buyer walks away for a failed closing condition rather than just walking away on its own. So that is one of the more significant ones. Sometimes there's also a specific right of termination if a MAC occurs. So it would give the buyer an opportunity unilaterally to use that as a right of termination, which also has some of those cost allocation issues with it. Those are the two that come to mind. The occurrence of it, though, also is more insidious because it can impact a lot of reps and warranties on your bring down. Can you bring down the rep that your financial statements have no undisclosed liabilities, for example? Can you bring down the rep that all of your receivables are collectible? So there are a couple of areas where the MAC can come into play with that. And then also some interim covenant failures are places where the MAC can have an impact too, that you're not, you're going to keep all material contracts in place, and then you have someone that calls a force majeure and suspends their operations. That's probably the most insidious part is really looking at those bring down obligations and then also your interim covenants.
Great, thank you, Bob. I'll throw this out to the three of you, anyone to jump in, but I think it just dovetails back, Bob, into what you were just speaking about. Then what do we see? What does the panel see as happening with valuations in deals currently?
I'd be happy to jump in. I think there obviously some downward pressure on them. The principles for valuation remain the same, but if they're based upon any sort of projections, you've got to rethink your projections. And so they're almost always, at least for most industries, since most industries are adversely impacted there, it's going to have a downward pressure on this. And then I think also on a go forward, there'll be a new risk metric in the assessment formula that also is likely to have a downward pressure on valuation.
Great. Ryan, I think this one is back in your court. The question is, for the employee retention payroll tax credit, if I had a significant decline in gross receipts for more than 50% for a quarter, when does my status as an eligible employer end?
Yeah, there was a lot of confusion around that point, but I think we've gotten some clarity finally. So let's say you become eligible in Q2. So your gross receipts are less than 50% of the 2019 Q2. So now you're an eligible employer. You remain an eligible employer until the quarter after your gross receipts exceed 80% of the same quarter in the prior year. So let's say in Q2, you're under 50%. In Q3, you're at 83% compared to 2019. That means you're an eligible employer for Q2 and Q3, but not Q4.
Okay.
That makes sense? Now, if you're under 50% in Q2 and you're at 75% in Q3, then you're going to be an eligible employer for all three quarters, Q2, Q3, and Q4. Okay.
And then we've got a follow-up on a similar point. For the employee retention payroll tax credit, do qualified wages for the entire quarter qualify if I'm partially suspended due to governmental orders?
Yeah, so if you qualify under the gross receipts test, then the entire quarter will be a qualifying period. But if you qualify under the full or partial suspension test, then only wages paid during the period where you've fully or partially suspended operations, only wages paid during that period are potentially qualified wages. So it may not be the entire quarter.
Got it. And then Kevin, we've got a question for you about the SBA, and can you tell us more about the refunding of the SBA?
Well, they're meeting on it today, so hopefully there will be some movement. I know it's been difficult, and I've even seen heard many cases where businesses have already been locked out of it. So again, I think that politicians recognize that there needs to be something done around funding as soon as possible. So I'm optimistic that they'll get something done today, but it's certainly. Just the mere fact that it was exhausted so quickly gives you a sense of how significant the stress is for those small businesses.
Yeah, we've got a follow-up or a similar question that I think is in that same vein of someone who's filed the PPP application on Monday morning, and they've yet to hear about an SBA number, and if we have any suggestions. Obviously, other than nagging their banker, it could just be tied up because of the volume of requests that have gone through the SBA system and potentially dollars being gone. But I'll certainly, if any of the three of you have any additional comments on that, I would love to hear it.
Yeah, I've heard that as well, Brian, occasionally. And the best thing is just call your lender. They should have responded by now, but there is a huge backlog. There's also a little bit of a potential backdoor that you can called the SBA liaison, but they're going to have the same sort of volumetric. Each state has an SBA liaison, but if your application's with Bank X, then call your loan officer at Bank X. That's going to be the most efficient way to get there.
Great. And then we've got a follow-up question about adding employees during the 8-week period. The question is, if I add additional employees, can I use more than 75% of payroll to justify as the forgiven amount in PPP?
I'd be glad to continue with this, but Ryan, you may have some thoughts as well. You can add, there's not a requirement that you have to limit it, but you have to spend at least 75% on payroll. And so you can spend up to 100%. And if your payroll increases and you use it, then you can certainly continue to use all of the proceeds for that.
No further comment. Unless Kevin
One
does.
other little addition on that deals with the reduction. The forgiveness amount can be reduced if your headcount or your payroll goes down. And so you can restore someone that you laid off. And if you get that restored by June 30, it does not count against your reduction number. And so for some that have laid people off in, say, February, and then now they're rehiring them because of the proceeds, that's a helpful variable.
Yeah, and I'll just, I haven't really studied the loan program like you guys have, so I'll just pose a question that when you go to do your forgiveness calculation, you're not differentiating between which employees were hired during the period, which ones already existed. You're just looking at the payroll costs during that 8-week period, regardless of when you hired the employee. Isn't that correct?
Yeah.
Correct.
Yeah.
So I know we're a minute past. We've just got a couple of last questions. I just maybe want to kind of go ahead and knock those out since it's an important topic, and I've got the three of you on the line. And Bob, this one really kind of goes back to your initial presentation. Just what are the benefits of waiting versus repricing versus risk sharing, and then maybe what kind of risk sharing is being considered?
That might be better for Kevin in prognostication. What's going to look like. It's an interesting forward-looking decision. If you are a survivor, if you're strong enough that you're going to survive and your competitors will be weakened, there may be lots of great opportunities. We saw that in 2008, that those that made it through suddenly had some great opportunities. And put out a little bit of props with all respect to a number of our other colleagues, but I received something from Brian Baker from Cowen that mapped out this and reflected that deals done in the 2008 recession cycle had some great ROIs compared to others. And so there are great opportunities out there. But if you're not a survivor, then the burn the hand theory comes in. Am I happier with 80% of X or 0% 2 years from now? I'd like 80% of X now.
Yeah. So the last question, and I'll throw this out to the panel. It's a great question, but it's also very open-ended. Do any of the panelists have comments on where opportunity exists or where to start a business? Other than PPP loan processing business, I'll see if any of the three of you have commentary on that.
Well, I'll take a stab at it. I mean, certainly one of the things that will change are attitudes toward commercial real estate, how much office space you need. So I think there are some opportunities there. For those of us that have done these Zoom meetings or WebEx or whatever, we know that there is consistently room for improvement in that kind of technology. And so even though we think we're really advanced, we're not quite as advanced as we would like to be. And then the other aspect of this that, it's unfortunate that prior to this crisis, there was a lack of incentivization for some of the innovations that really improve quality of life. And so what a crisis like this does is it forces the reevaluation, and it starts to incentivize some of those innovations that probably, we wanted to get to at some point, but it was easier to make video games and things like that with technology in the near term. So I think longer term, you will see the healthcare innovations that dramatically improve quality of life, telehealth, you've seen that start to really expand. It was already expanding, and that's accelerated it. And then when you look at things that 5G will make possible in terms of treating patients from a distance and improving the quality of healthcare that they have, even if they're in rural areas, I think those are all areas that you can look at as ripe for some of the positive benefits as we emerge from this.
Great. Well, I know we've run a few minutes over, and I want to thank our attendees for their time today and using a portion of their day with us. But I really want to thank Kevin, Bob, Ryan. The three of you were great. A lot of great insights. I know I learned a lot from this. So the ACG has recorded this webinar, and it will be available on the ACG Indiana website. So thank you, everyone, for attending, and thank our panelists for all their hard work and efforts.
Great. Thank you.
You're very welcome. Good to be with you.
Thank you.
Electronically. Thanks.